Hello and welcome everyone, and happy St. Patty's Day. I am Rachel Dishell, your host for Long Options, and I'm also Senior Manager of Trading Services here at Charles Schwab. Now, this is a class where we make the assumption that you are already familiar with the basic concepts of long options or options in general. But if you're not, you're more than welcome to stay, but I would definitely check out our Getting Started with Options playlist first before kind of building on some of those concepts. So I do have Kevin Horner in the chat today. Please chat in your questions, comments, requests during the session today. I'll be sure to keep an eye on those. Please follow us both on X. I am Rachel-CS. Kevin is Kevin Horner CS. We both love charts and technical analysis, so you're going to see a lot of that on our X platforms. And also, please give this video a thumbs up and subscribe to us on Trader Talk Schwab Coaching. Now, for those of you that watched one of my webcasts yesterday, I am wearing the same shirt. Maybe you're wondering why. It's just because it's green. It's St. Patty's Day. So I have other shirts. But we're going to dive in today for looking for volatility squeezes, price compressions for that recipe for some larger breakouts where we can get a little bit more directional. So we're going to go through that today, give you a few different example scans. But before we get started, let's hop into those important disclosures here. So options carry a high level of risk and are not suitable for all investors. Information we're going to cover is for general informational and educational purposes only, should not be considered any type of recommendation or advice. And we are covering the Paper Money software application. There are definitely some differences between Paper Money and Live, so keep that in mind as well. Now, before we get into the agenda, we have some upcoming workshops and market drives. You could see there on the screen when and where. I am going to be at that Denver one at the end of March. That's going to be super fun. Hopefully not too cold. I'll also be at that Boston one the middle of April. So give me a shout out if you guys are going to be there as well. I'd be super excited to meet each of you guys, but a lot of exciting things coming up here. Now, as we move into our agenda, we are going to obviously start by the way we always start. So we're going to do our market overview, review past trades. Then we're going to get into the meat of the segment, which is discussing the concepts of long options, price, time, volatility, heavy on the volatility today, stressing that. And then we're going to place some example trades on the Paper Money platform. So let's dive into Thinkorswim and start with our market overview here. So we did see a little bit of a bounce from right around this horizontal support, right around 65.50 or so, right above that 200 period moving average. That still remains the line in the sand for bulls. We are still holding that horizontal support. We're still holding that structure there, and especially with the 200-day, which we haven't been under that since really last March, last April, if we zoom out a little bit more. Obviously, we have been churning through a lot of this sideways action. There are still opportunities that exist in this market though, so that's why we're going to cover a couple different setups today. So those are kind of the long-term levels to keep an eye on there. Now let's talk about some of our trades from the previous weeks. Okay, so we did look at some short-term setups, maybe some repair happening last week in technology and communication services. We were quickly stopped out of our NVIDIA trade. We wanted to make sure we were stopped out right away if price really re-entered that pattern that we were looking at on the shorter term chart. I think it was a possible double bottom that we were really looking at there. Now Google, same thing. We're still kind of awaiting that order for our trigger. Are seeing a little bit of a bounce today in Google. And then lastly, we still have our leaps on for Halliburton. We're up quite a bit on that today, up overall on that one. So that is what we have here for our trades of the past week. Now, let's get into a couple different things. So what I want to first give you guys is just kind of a couple different example scans or ways of searching for just kind of low volatility stocks. Because we know that obviously the main things that are going to be driving the price of your option is going to be obviously the direction of the stock. So what price is doing. That's one of the main factors. We have time to consider. And as a long option holder, like we talk about in this class, time works against us. So that's something that we always want to keep in mind too, to give ourselves enough time. And then really the third big thing that we can really use in our favor when crafting an option strategy, a long option strategy, is levels of volatility. And so if we have lower levels of volatility, the options prices are going to be relatively less expensive than they are in periods of high volatility. So as an option buyer, we want to really search for these lower compressed levels of implied volatility, because if implied volatility increases, the value of our options also increases as well. Now, the thing to keep in mind here about volatility is it is mean reverting. You've seen that with the VIX, the fear factor index, the volatility index. You have seen that volatility is mean reverting, which just means when you have periods of low volatility, they tend to switch to periods of high volatility, and vice versa. When you see periods of high volatility, they tend to switch to periods of low volatility. So keep that in mind throughout our session today, because that is a huge factor with volatility. It is mean reverting. Asset prices are the things that trend. So you won't necessarily see those trends in volatility. You'll see mean reversions in volatility. So we want to keep that in mind as we go today. Now, there's obviously a few different things that we could look at, a few different measures when assessing volatility. Now, one of them being, let's just take a look at the chart real quick. One of them we can just throw implied volatility on the chart. So I'm going to show that here on the chart, and you can just kind of see down below. This is one measure. The base measure that we're using for implied volatility is just to give us that concrete value there. Now, what we can do as a options trader is we could look at this current level of volatility, whether we look like a visual of looking at it on a chart, or maybe we're more of an analytical, mathematical person that likes to look at it on a percentile basis. But essentially, we can look at the current market environment as far as volatility and see whether that's relatively low or high. So those have been a few different ways that we've talked about in the past of just framing our strategy, is looking here on the chart, seeing if it's relatively high, relatively low to where it's been over the past year. And then typically we go to the trade tab under all products, if this would load for me, and we typically look at the implied volatility percentile down here under today's option statistics. So that really tells us where the current level of implied volatility ranks compared to where implied volatility has been over the last year. So that tells us whether it's relatively high or relatively low. Now, there's a few different other calculations, measures, or indicators of implied volatility that we're going to talk about today. And before I actually get to the scan, I know I showed you guys a preview of it. I am just going to talk about a couple different of these, and a lot of you are probably pretty familiar with some of these measures as well, but the two that we want to talk about today is the Bollinger Bands and the TTM squeeze, since we're going to use both of them today. So the Bollinger Bands are going to be essentially that measure of implied volatility. So when we look at the Bollinger Bands here, we can see that in the middle, we have this 20 period simple moving average. And essentially what this does is it plots a line 2 standard deviations above that 20-period simple moving average and 2 standard deviations below. So essentially what this is going to do is these Bollinger Bands are going to essentially contain 95% of the price action. So if we think about a normal distribution curve, 2 standard deviations away, that encompasses 90% of the price action. So that's a very large percentage. But because volatility is mean reverting, we will have breakouts from these bands, and this is where you get those tail events. So what we're looking for as traders is we're looking for when these bands really get really tight and compressed, because when they get really tight and compressed, that means price is getting really compressed, volatility is getting really compressed, and it's bringing us into more of a volatility squeeze type of environment, which we've talked about before just a minute ago. Low volatility tends to switch to high volatility. So that is what we're essentially going to look for, is we're going to look for these squeezes in the Bollinger Bands. So we're going to look for the Bollinger Bandwidth to get really small. So I wanted to show you guys that on the chart. Now, what you can use to not necessarily, we'll build a scan for it obviously, but for lots of traders, when they're discerning price action, the Bollinger Bands can get a little messy on your chart. So one thing a lot of folks like to do is place the Bollinger Bandwidth as a lower study here. So if you just search Bollinger Bandwidth, you can hit apply and OK, and this will show you whether it's high or low. And I'm going to use a different example here. I'm going to use Rocket Lab, since this is going to be one of the stocks that we're going to talk about today. Okay, so we're going to look at this Bollinger Bandwidth, and I'm going to expand it here. And you could see right now the Bollinger Bandwidth is near the bottom of this chart. So it's near the bottom of this chart, which means that Bollinger Bandwidth is just getting squeezed and squeezed and squeezed. So this is essentially what we're going to look for today in our scan, because we know low volatility switches to high volatility. And another important thing to keep in mind with this is typically increases in volatility accompany price breakouts. And I know because of the VIX, volatility kind of gets this negative connotation, and we always think that traders tend to think that increases in implied volatility come with a downward price action or panic, and that's definitely not the case. Volatility works in both directions, so price can break up on increasing levels of implied volatility, and price can break down as well. So we want to keep that in mind today. Now, the other thing I want you guys to look at, which kind of goes hand in hand with the Bollinger Bands, is we're also going to look for a TTM squeeze as well. And a TTM squeeze is essentially just looking at a comparison of the Keltner channels, which is taking bands around the average true range essentially, and it's looking for when the Bollinger Bands enter into those Keltner channels. So you can see here the Keltner channels, they look very similar. They're in orange. You have 3 bands. Those are taking the average true range and using that as a volatility measure. And you have the Bollinger Bands that entered into the middle of the Keltner channels, which is again another signal of a volatility squeeze, and we call that the TTM squeeze. So we're going to scan for that today as well. I wanted to just lay this groundwork for you guys, just so you're seeing the visuals, seeing more of the illustration of what we're essentially going to scan for, and then we'll get into a few different trade examples here. So if you guys have any questions on this, let me know. I'll kind of move to the next part of this segment as well, with building the scans and how we get to some of these. So I'm going to hide these from the chart just so we have a little bit more clarity on the price action, and we'll go back to the scan here. Okay. So one of the scans I built, which I'll share this with you guys, we're looking in all listed stocks. We're looking at stocks that are greater than $20. looking for stocks that have a level of liquidity. So the average 50-day average of volume is greater than 1 million. We're looking for that implied volatility percentile between 0 and 50. And that's kind of one of those things that we talked about as well. You could see that on today's option statistics. And then we are looking for a stock that's undergoing a TTM squeeze. So when the Bollinger Bands squeeze in between the Keltner channels there. So that's what we are looking for. So we're going to hit scan here. It's going to give us some results, and I'll share this with you each as well. Share scan query. You can use this as an example for looking for volatility squeezes to set up and look at some of those technical levels when you're deciding whether you want to buy a call or buy a put. And this is not guaranteed for accuracy, timing, or results. So putting that as an example there. So that's going to give us quite a bit of different stocks to look at. Okay. So list there. Now the next one I want to cover is that Bollinger Band one, and I wanted to give Kevin a shout out for this one because I personally am not great with ThinkScript. I know visually what I'm looking for, but he contributed to helping build this scan a little bit too, so wanted to give him a well-due shout out there. And let me see, this one is our Bollinger Band squeeze long options. Okay. So this is going to look for stocks similar to what we saw before, greater than $20, have a level of liquidity, are uptrending, so are above their 200 period simple moving average. And the last one that we want to look for, I'm going to click on the pen to really show you guys what we're scanning for here. We're basically defining the Bollinger Bands, the Bollinger Bandwidth. And we're looking for the lowest Bollinger Bandwidth in the last 125 days. So that's essentially what we're looking here for on this scan. So I'm going to click OK. I'll share this scan with you guys as well to give you guys a little bit of an idea. Again, not guaranteed for accuracy, timing, or results, but again, just the definition there. Okay, I'm keeping an eye on the chat. Let me see if there are any questions here. Okay, let's see. Okay, so I have a question. Why are we wanting implied volatility below 50? Great question there. So we're not looking for the level of implied volatility being below 50. We are looking for an IV percentile between 0 and 50. So because when we think about a percentile, the lowest is going to be like that first percentile, the highest is going to be 100. And so what you're doing is you're using this ranking system of where the current implied volatility is right now. So if I use Rocket Lab as an example, the highest level of implied volatility for the last year was 127%. The lowest level of implied volatility was 70%. Okay, and so right now, our current level of implied volatility is 88%, which you can see here. So that falls, if we look at a percentile between these ranges, that falls in the 31st percentile there. So that's going to tell us that the current level of implied volatility is actually in the lower third of where it's been over the last year. And the reason why we're looking for that lower level or that lower half on the percentile is because we know that the option prices are going to be relatively a little bit cheaper than they would be with higher levels of implied volatility. And we know increases in implied volatility are going to work in our favor as an option buyer. And so that's what we're stressing today. We are setting up options trades to buy at price coils, be buyers at support. We're looking to really test our bullish thesis here, but getting long volatility as well in these example trades. So hopefully that answers your question there. And then I see Stay Gold Always said, come on, Rachel, you took the month off. We need a really good trade today. Yes, I am finally back. I'm excited to be trading with you guys, and hopefully I'll give you a few good examples here today just over the concepts that we are talking about. So when I was running some of these scans over the last over this morning as I was prepping for this webcast, a couple different things really caught my attention, and Rocket Lab was one of them. And I want to kind of take a look at Rocket Lab, because if we look technically speaking here, if we look technically speaking here, we have seen that price has held this level of support right around the midpoint of this really big candle from December. So we've seen that price has held that level, and price has actually been coiling for the last month and a half here, where we have lower highs, but we have higher lows here. And actually, I set up this trade before price actually broke out today, but if we look down below, we can still see the Bollinger Bandwidth is still coming off of those some of the lowest levels there, and we have a confirmed price breakout of that coil, which we talk a little bit about more of these formations in my class on Wednesdays, Trading Price Patterns. But essentially what we're seeing here is we're seeing that price when it's making lower highs and higher lows. You have the bulls and the bears really battling it out, and they're using the forces of supply and demand to really press those prices closer and closer and closer together. And so what happens when you squeeze and you squeeze and you squeeze, almost like you're squeezing a toothpaste bottle to get the last little bit of toothpaste out? Well, if you squeeze too much, you're obviously going to have an explosion one direction or another. And so this is typically what you will see when you are having these coils and prices coupled with a compression and implied volatility, which is what you are seeing here. So in this sense, what we're going to do, since we did see support being held, we already saw a little bit of structural repair. We're seeing a breakout of that pattern today. We're going to buy some call options in this one today. We did see that the pattern formed over a period of a month and a half, so we want to give ourselves at least a month and a half of time to see this resolve to the upside. So we're going to go to trade all products here, and I'm going to look out at the 18th of June with 93 days left till expiration. That gives us roughly about 3 months or so, so that gives us quite a bit of time. And if we look at some of the Greeks here on the option chain, we can see, as far as like theta or time decay, we are theoretically going to lose about 7 cents every day in time. We can also see with our Vega, with our 1% change in implied volatility, our options should theoretically move up or down 15 cents or so if we're just kind of looking at the example of the at the money. And then we can use our delta to really select our strike price to look for a little bit more of intrinsic value, maybe a little bit more of a move in our direction if the stock does move in our direction. So what we're going to look at here, let's look at the 70 strike call here on this one. So we're going to look for a delta of 0.67 on this one. This one's going to be $6 in the money. We have a pretty tight spread there, decent amount of volume, but the main thing we're going to look for is that spread there on the bid ask. So we're going to click on that one. Actually, I'm going to go right click on that one, and we're going to go to buy custom with OCO bracket. Okay. And we're going to bump this up because we know that within our account, we can place $10,000 into a trade. We're only going to essentially risk, our trade risk is going to be $1,000 to $2,000. We've talked about that before in this class. So we're just going to bump this up. We're going to do 5 contracts here on this one. We're going to tie these all together with a good till canceled order. Okay. So, what we're going to look at here is We're going to enter this one. We're going to try for the current midpoint here, okay? And what we essentially want to do is we want to place an order for our upside and our downside. So we want to take profit and we want to also limit our losses to the downside. Now keep in mind when we're buying a call option or when we're buying options in general, the most we could lose, the most that we have technically at risk is the most is the amount that we're paying for the option. So that's the premium there. And so if I go to this next page, you can see we're putting about $8,000 to work. We're putting about $8,000 at risk. But we are going to limit our risk, attempt to limit our risk with a stop order here. And so essentially what we're going to do is we're going to look for a 20% loss on the downside, 20% gain on the upside. So that's where we're going to put our targets today. Now, a lot of traders may say, I want a different type of risk to reward. Now, you can definitely play with that as well, but we just want to put some hard and fast guidelines as far as where we want to get out on the downside, where we want to exit on the upside should it move. So I'm going to take 1615 and multiply that by 1.2. That's going to give me a price target of 1938. So 20% gain on the upside. Now if we take 1615, multiply that by 0.8, that is going to give us our downside stop, which would be 1292. Now, keep in mind, there are risks with these stop orders. So first of all, stop order triggers off of the asking price of the option. So that higher price of the option, and it's going to become a market order. Now, there's no guarantee that the price of our option is going to fill anywhere near that price. Price could gap down overnight and open at a completely different price, giving ourselves not necessarily a fill that's anywhere close to where we placed our stop. So kind of keep in mind some risks with stop orders there. If you want to have more control over the price, there's different types of orders, but keep in mind that is one of the risks. So I'm going to hit confirm and send here on this one. And we are going to place this in our long options class here. So 1615, 20% gain, 20% loss, and we are going to hit send on that order there. Okay. So that is one. We saw the breakout from the coil. We see that implied volatility is low and starting to rise, just a teeny tad. Okay, so next one we are going to look at. Now, this one is a little interesting. This one's a little bit different, but I wanted to bring this one today because it's a little bit different than what we typically look at in this class. So we're going to look at Oklo today. And if you guys look at the long-term chart of Oklo or the 1 year, 1 day, you can clearly see that Oklo or Oklo, however you pronounce it, I pronounce it Oklo, you can see that it has been in a downtrend. So it's been making lower highs and then subsequent lower lows as well. Now, something notable is we did have this level of support right around here, this zone. That's really been crafted out over the past year. And we can see that we had this bullish engulfing candlestick really take shape there. We saw price move and close above it. And then ever since, it's kind of moved back down here. Now, couple different things about this one. We're going to talk about both the long-term structure of this one as well as what we're seeing in implied volatility. And maybe you guys have seen this already. We have a little upcoming event later today. So typically with earnings announcements, you are seeing the week or 2 weeks before, you're seeing that increase in implied volatility typically leading up to earnings. And the reason why is because you obviously have a lot of uncertainty around earnings. There are options traders that are sitting there buying options, especially put options, and looking to hedge their long portfolio on uncertainty. So with the buying of options, you have the level of implied volatility rising. It's a cycle there. But this isn't exactly what we're seeing going into this earnings announcement, which is interesting. So we're actually having this price compression here, and I'll kind of show you what we're seeing from a price perspective. We're having this price compression here right at this long-term level of support, and I'll even show you guys another interesting thing about this trend too. So you're having this coil really taking place at that long-term level of support, and you have volatility getting to some of the lowest levels that we've seen in the last 6 months. So, which is typically not what you're going to see leading up to an earnings announcement, right? Which is typically why in this class we avoid an earnings announcement. But we're going to use this one for our example trade today. And the reason why is because we have this coil, we have this volatility compression really taking shape at such a both long and short term pivotal crucial level in this stock where we may possibly see buyers step in here and really look to trade in the direction of whichever way price breaks for this upcoming earnings. Now, if you don't necessarily know which side of the market you really want to play here, whether you're long puts or long calls, a lot of times traders may look, if they're just looking for a large move leading into earnings or some announcement and volatility is still relatively low that supports that option buying environment, they may use a long straddle or a long strangle. And essentially what that is with a long straddle is you're buying a call option, you're buying a put option at the same strike, same expiration. And with a long strangle, you're buying it at them at different strike prices. So essentially with those strategies, you're expecting that major move. Now, I think Connie Hill teaches a class on straddles and strangles, so you guys may want to check that one out as well because she looks at a lot of different scenarios like those with kind of like leading up to earnings and major events and things like that. The reason why we're going to look at this one and buy a call option is because we're going to look at being buyers at support here for Oklo. So what I did here was I drew a couple different levels, okay, and I'll draw another one as well. This is basically Oklo's chart from when it first IPO'd, and this is a max weekly chart. So the first kind of thing I did was add an anchored VWAP in, so an anchored volume weighted average price line, which is typically that level that folks are looking for as far as like levels to step in and buy at support or sell at resistance. So those are really pivotal levels there. From that first week that it started trading, and right now price is currently sitting and has bounced off last week actually off of the anchored VWAP here, so it's still holding that level. And then in the long term, we've also seen this kind of stair-stepping of price. We saw price break out, hold support there, retrace back to support, break out and hold that level here. So essentially what we're going to do with this trade is be a long-term buyer at support. We're still going to look a couple months out from expiration, but essentially what we're going to do is we are going to take advantage of the compressed levels of implied volatility and look to be a buyer in here at support. So that's essentially what we're going to do with this one. So if we go to the trade tab on Oklo here, let's take a look at the 18th of June. Still a couple months left from expiration, just like the one we previously looked at. And let's take a look at the, we're going to look at the 55 strike call in this case. So let's take a look at the 55 strike call. No, let's do the 60. The gamma still isn't is the same level there. The only thing with buying the at the money options there typically is with Gamma, which is like really your gas pedal of your Delta. Typically those options will respond really quickly to changes in your Delta, so those at the money options can be a little volatile there. So typically that's something to kind of keep in mind, but we have the Gamma risk that's kind of uniform throughout here. You'll see that Gamma get larger and larger closer to expiration there, but this one's still slightly in the money with a delta of 61. So let's go with this one here on the 60 strike call. Now, what we're going to do for this one is actually we're going to look at buying a call option here on this one, and we're just going to buy one contract. So we don't necessarily know where price is going to go, but we are going to buy one contract because just the one contract, we do not have to worry about a stop loss in this case because the cost of this contract is still going to stay within the risk parameters of our account. Because we mentioned we started with a $200,000 account. We don't want to risk more than 0.5% to 1%, so $1,000 to $2,000. Now, if we selected a out of the money option, we could do up to 2 contracts, but we're just going to work with this 60 strike call here on this one. And we're going to place this order on at the midpoint of this option to just try to ask for a little bit of a better price here. So the most we are risking is what we are paying for our premium. So that is roughly just under $1,200 here. We're going to place that in our long options class. Okay. So we're going to place that there. Now, where could Oklo go if we do see a bounce to the upside? Because there is an expected move. There is an expected move leading into this announcement. And so where could we possibly see Oklo bounce if they did have a bounce to the upside? Okay, so a couple different levels here. One may be right around this level, right around 72, 73 or so. And then the next level that's been touched quite a few times is around this 113, 114, 115 zone. Okay, so if we did see a bounce, we could first see price really touch this near-term zone right around the low 70s. If we do have a continued trend to the upside after a possible bounce, again, we're not forecasting, but just kind of calling out some technical levels on the chart, that could be another level in question. Now to the downside, where may we be looking? Well, to the downside, we may see these lows right around 50 start to get retested if this entire zone breaks. So we may say 50 would be a level to watch there. So if it breaks below $50, we may say, hey, we want to get out of this trade there. So a couple different ways, a couple different levels to kind of keep in mind here. So a little over 70 to the upside, 50 to the downside to watch. Okay. Now let's see. I think we have time for maybe one more really quick. Okay, a similar chart that we're seeing here is Super Micro Computer. So similar formation that we're seeing for some of the other ones as well. We're having that price coil, we're having that compression. We're reaching some of the lowest levels or the tightest squeezes of the Bollinger Bands that we have seen. We're seeing volatility compression now supports the environment to be a buyer of options. Now, we're not essentially looking to, in a sense, really worry about trading this price pattern. That's not what we're looking to do. We're looking to trade repair. We're looking to go long volatility, long direction in this sense. And so typically when we see those coils or those triangle patterns that we've seen, those compressions happen at these crucial levels of support, they typically tend to be reversal patterns. And so what we're going to do, since we've seen the higher lows taking shape and we're seeing the lower highs here, what we're going to do is also take a long call on this one as well to get a little directional in the repair phase of Supermicro. So we're going to look at the trade tab. We're also going to look at a few months out until expiration, and we are going to look at the, let's look at the 31 strike call. So slightly in the money there. Not a ton of volume, but still a tight spread on the bid and the ask. So we're still looking for a spread of 10% or less. So we're going to do the same thing here on this one. We're going to buy 3 contracts on this one. Similar to what we did on the last one, we are still staying within the risk parameters of our account. We are only risking a little over $1,500 in this sense. We're going to try for the midpoint there on this one. We're going to hit confirm and send and go with our long options one there. So I'm going to hit send on that one. Okay. I see a lot of talk over these trades today. Kelly saying SMCI is dead to me. Well, we're just going to let price do what it does, do its work, and we have risk-defined trades in and ready to go. Today we're mainly focusing on those price coils, big possible breakouts to get directional with a bullish bias here being buyers at support. So essentially that is what we're looking to do, or we have done today in this class. Give you a couple different example scans of how to look for these volatility compressions or volatility squeezes to maybe set up future directional trades or long volatility trades, and then just kind of showing us what to look for on the price chart, what to look for as far as volatility, those types of environments to possibly be directional at a level of support. So since we are nearing the end of our class today, I did want to give you guys a big thank you for being engaging in the chat there. I also wanted to give a shout out to Kevin just with being so active answering your guys' questions there. If you guys liked the video today, liked the scans, please give me a thumbs up on this video. Please hit subscribe on our Trader Talk Schwab Coaching webcast, and please follow Kevin and I on X. Lots of charts like this before we even cover them in our webcast. So I'm Rachel Dash CS. He is Kevin Horner CS. Thanks for joining me today, and I hope you guys all wear green and don't get pinched. Enjoy your St. Patty's Day.